You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Today is February 9th, 2022. Well, metals prices, they seem to be range bound for the past year or so. Just when you think they're about to go up, something happens. They get slammed. Just a little more than a week ago, gold was trading again under that crucial $1,800 per ounce level. And this is important because if you invest in mining companies, if you are a precious metals investor because you believe that it is the ultimate wealth insurance policy, well, maybe if you're in the metals, you take a longer view. But if the metals are doing well, then the companies are going to do well. And generally, the companies lead the metals prices. And when you see them in recent times where the metals prices lead the companies, pause for thought. Well, we've got an expert on with us, somebody who runs through his lifeblood where these metals prices are at, because his company's future is inexorably tied up with futures metal prices. Kyle Floyd is with us now, CEO of Vox Royalty, which is a royalty company out of Canada. Kyle, it's great to have you on the show. You've been frustrated by metals prices recently?
Yeah, and Kerry, thanks for having me on the program. It's a privilege. I am a little bit frustrated by metal prices, but I think one of the things that investors have to realize is, the movement won't happen until it's too late. It literally has to be the 2x4 across the face for, let's call it, the more generalist population to wake up. From my personal perspective, this doesn't necessarily, influence how we approach royalty investments, which is what our business does. But from a personal perspective, the fundamentals seem to be there in spades for the metals. And at some stage, I think those fundamentals are going to be reflected in the price. And that's really the kind of the general sentiment in the industry. And what I can tell you I'm seeing firsthand is funds and groups, you're talking multi-billion-dollar family offices, hedge funds have called me and said, how do we get exposure to the metals? How do we do it right? And we've never really focused on it, but we want to now. So that's kind of a leading indicator from what I'm seeing firsthand in terms of interest in metal prices based on inbound calls to us asking how they get the right kinds of exposures and what to expect.
Well, what I personally find remarkable is we've had records amount of currency units created in the past 2 years since the pandemic, right? For whatever the reason, we don't need to get into the whole health issues. That's just kind of irrelevant for our discussion, but I think it is important. Don't get me wrong, but we've had record amounts of currency units. At the same time, we had production across the globe, across the supply chain shut down. So therefore, you got more currency units chasing less goods and services. I mean, that is a fact nobody can deny. And you don't have to be Ludwig von Mises or Murray Rothbard to figure out that, goods that are fixed in supply, and when you have monetary printing, debasement of the currency, and out and out inflation, metals prices should be going higher. And yet, we've seen them go higher from their lows, but we haven't really seen them make new record highs. Do you find that alarming at all?
I don't know if I find it alarming. I find it interesting for sure. And, my personal perspective on it is that, we're in a time when you're starting to see the alternative asset classes start to deteriorate in terms of investor sentiment. And there's no denying that, let's call it the generally cryptocurrencies, whether it be Bitcoin or Ethereum or NFTs, have taken a lot of the investor imagination and drawn that away from the metals. The metals are viewed as boring, but I think we're going to head into a period of time where boring is what investors want. And the volatility and the overwhelming kind of upswelling of supply and demand fundamentals for metal prices, I think will, in context and alongside of investor interest growing, I think we're going to run into a very, very positive market for the metals. And so that's my personal belief on kind of where metal prices are heading and some of the reasons why.
Hey, so you're in the capital formation business for mines. You raise capital to bring worthwhile production projects into production. And really, over the past decade, or really, I would argue maybe 4 or 5 decades, we've seen tremendous underinvestment in the mining sector. And at the same time, we're going for energy conversion from hydrocarbons to electric from whatever source. At the same time, there's going to be record demand placed on resources to help facilitate that conversion. Do you see the irony to this and the potential problems on the horizon?
I do. And, the interesting thing is there's not an investor that I meet with that isn't bullish on, say, copper as part of this energy transfer from hydrocarbons into the metals and the capital transfer that's required to make that happen. But the interesting thing is, what you're going to see is across all the metals, whether you're a gold miner or a copper miner, you're competing for a lot of the same people and a lot of the same inputs. So what's about to happen is if copper prices run like people think that they can because of this energy transition, well, then you have the mining companies competing for those same individuals, experts, inputs, you name it. And that's going to continue to create price pressure, further price inflation that the miners realize. And so you either are going to have to put out the kind of store of value discussion around gold and silver, because that's what we focus on, but put that to the side of this equation. The reality is you're going to start seeing so much supply come off the market if those prices don't kind of trade in parallel, that I think the outlook for gold, the outlook for silver is very strong, because you're going to see all the metals really across the board be competing for the same inputs, and either their prices rise or supply is going to come off the market, which will ultimately raise prices to where they need to be. So I think across the board, metals are really, really well positioned. And so I don't look at it necessarily as, yes, the energy transition is going to help metals like copper or nickel maybe a little bit more, but there's so many different kind of facets of demand and pressure to move commodity prices north that I think really across the board, you're going to look at what I believe will be another super cycle in the metals.
I'm inclined to agree with you, and I'm just surprised it hasn't happened yet. Now, let's talk about energy prices. Okay, we talked about energy conversion, but in the meantime, the world runs on oil and nat gas in that order. But nat gas, very important. We've seen escalation of prices. We're heading towards $100 per barrel oil. And we know in the mining industry, heavy energy intensive business. So just on the basis of energy costs going up, if the metals don't follow energy, that's going to curtail output as well, isn't it?
Yeah, there's so many different data points that are what I believe going to provide this upwelling support and momentum to metal prices. And it's not just one factor. It's, look, diesel and hydrocarbons are a big input for the miners. That's a big cost for them. And that price is raising. So that's, again, more pressure. And if the metal prices don't react to that, well, then there's going to be some marginal producers that come offline. And then that obviously shrinks supply, which helps prices. So kind of every angle that you look at metal prices right now, you asked me if I'm frustrated. I'm not really frustrated, because at the end of the day, I think this is the time when the fact pattern has never been so positive for the metals, that accumulating, we do it via royalties, but there's obviously, whether you're buying physical or other opportunities within the metal sector to get that exposure, I think this is the right time to be accumulating. So taking that frustration out, putting that into the energy of finding good opportunities is kind of what our focus is right now.
Right. And opportunities, that's what it's all about. Of course, one thing we talked about before is you don't have a lot of new blood going into the mining industry. And what's it going to take for a kid in college to say, becoming a mining engineer or a geologist and helping develop resources really is a great career. Traditionally, all wealth came from the earth. It's only in the past 100 plus years, maybe 200, where the knowledge economy has really taken off. To me, I think it's a great career, and I'm almost sorry I never considered it. I went to law school. My math skills weren't perhaps where they needed to be, but replenishing the labor supply of these vital industries should be every resource-based economy's major goal, as well as upping production.
Don't just survive, thrive. The Financial Survival Network.
American Eagle Gold is focused on exploring for a world-class gold deposit on its flagship property, Golden Gate, located in the Cortez Trend next door to Barrick Gold and Newmont Mining's Gold Rush and Cortez Mine. They have produced over 27 million ounces of gold. The company plans to drill and advance its relatively unexplored property and continue to focus on acquiring and advancing gold projects in the area. Vice President of Exploration Mark Bradley was at the helm of the team that discovered and defined Gold Rush and has spent the better part of 30 years working on the Cortez Trend. American Eagle trades under the symbol AEG on the TSX Venture. For more information and to sign up for notifications, go to americaneaglegold.ca.
This is the Financial Survival Network, the information you need to thrive now more than ever.
It's a really interesting fact that you point out, in that there has been this discontinuity that's developed over the last 20, 30 years, where the younger entrants in the labor force are not picking mining. I'll give you an example. I went to the University of Washington in Seattle for finance, then went back to Colorado School of Mines. Out of a graduating class of probably 30,000 students, I can tell you definitively there's probably less than 10 that have anything to do with the commodity sector. That being said, probably about, let's call it 20% of those graduates went into some form of supporting tech, whether it was Amazon or Microsoft. And so you really have a dearth of supply of new entrants into the space that are going to be needed to help fuel this transition into the metal commodities. Hydrocarbons has been a bigger draw. It's been a much bigger part of our industry in the US especially, and even Canada in many respects. But at some point, again, this conversation geared around what's impacting metal prices. At some point, there just aren't enough people to work the operations. We're seeing that in Western Australia right now, where we have we believe it's the best mining market on the planet. But what we're seeing is projects and companies are having such a terrible time finding talent and people to work their operations, whether it's a drill rig or a metallurgist and everything in between. It's so hard to get people. And some of that's because of borders being shut down, but there's a systemic issue happening right now in the commodities industries. And that is whether it's cryptocurrencies or NFTs or tech has been such a huge draw. Wall Street sees this as well, has been such a draw for talent. And the metal sector specifically is seeing, just a huge exodus of talent, and they haven't had anyone refill the coffer, so to speak, from that perspective.
Yeah, there's a real shortage of those people from like low 20s to like mid 40s, early 50s. It just reminds me, there was a movie called Margin Call. I don't know if you ever saw it. Dealt with the crash of 08 and 09. One of the best movies on that topic, that genre, anything. And the guy who figures out that their mortgage-backed securities are worthless is an aeronautical engineer. I mean, literally, almost a rocket scientist. And I'm thinking, like, this guy should have been working, for a major aircraft manufacturer or subcontractor or whatever, or NASA. And here he is. And I don't blame him. He sold out, basically took the highest offer, which they needed his expertise on Wall Street. And there he is. But maybe this is a case where capitalism maybe doesn't work as well as it should.
I think it's going to, and I think that's what we're getting to, is we're getting to that point where the metals have been so underinvested across the board from pretty much every perspective and every angle. Metals have been underinvested in the infrastructure, the people, you name it. And the reality is this: people like to grab hold of tangible fundamentals. And the easiest tangible fundamental to understand is the trillions of dollars that are in hydrocarbons have to go to metals. And that rising tide will almost invariably raise all boats in the metals. And there's going to be better performers and worse performers, but that's going to raise the tide for everyone. But it's not just that one factor. It's not just that one issue. Think about that overwhelming demand on people talent, as we're talking about, or inputs, or the governmental agencies that cannot rapidly expand to deal with permitting and everything that governments have their hands on in terms of allowing these projects to come into production and continue to produce. There's just not enough of any of it. And there's going to be a day of reckoning when everyone realizes that this energy transition that by and large is very, very popular is going to have an immense cost attached to it. And that is going to be a very, very good day for everyone that's invested in metals. And it looks like that tide is slowly but surely coming in. And so, programs like yours of educating investors, I think, is really, really valuable right now, because if you know where to invest, you know what to be looking for. I've never seen kind of all the boxes be checked for what should be a very, very bullish cycle in the metals.
Oh, yeah. And, not to overplay it, but it's potentially disastrous because you cut back on hydrocarbon investments too rapidly before the true transition. Really, all those issues you just mentioned are addressed, and we're going to find ourselves in an unenviable position of not having enough of anything. And that's really problematical, potentially disastrous. Hey, talking about Vox Royalty, company's been around for 10 years. Just give us an idea of your royalty streams that are out there. And hey, tell us first, though, how'd you get into, as a miner, how'd you get into royalty?
Yeah, it's almost 10 years. So Vox Metals Corp was created for investors by investors. We looked at the space and Kerry, as you know, and a lot of your audience knows, investing in mining companies is hard. And that's part of the problem that mining companies have is such an esoteric industry. There's very esoteric risks, whether it's geology or engineering or metallurgy or permitting. There's so many risk factors that attack a mining company, as you and I kind of have spoken about. And that makes it really hard for an investor. And so I previously banked the sector, and it was really hard for the generalists to understand where to put capital in the space and match what their return expectations were with the risk that you're inherently taking on. And I believe royalties, generally for the generalist audience, provided that opportunity best. And so went about building a company that could create a niche and a way of finding value in what is now a very hyper-competitive sector, but a way of finding value. And, it's kind of prescient in some ways because I built the company for an inflationary period of time. And when investors were looking for what asset classes can they get in during inflation. And so I started working on this company back in 2012. Inflation was not necessarily top of mind for investors. It is now, but the unique opportunity that royalty companies present to investors is that we're not exposed to those input costs that the miners face that eat away their margins. So gold being at 1,800, from my perspective, is a pretty good price. Do I think it goes far north from where it is? Yes, I do. But $1,800 gold, a lot of the mines that got put in production over the last 5, 6, 7 years should be making pretty good money. However, these inflationary pressures are chipping away at those margins significantly and making a lot of things very difficult on the miners. Well, a royalty company, we take revenue off the top line. We're not exposed to all those cost pressures that affect the mining company. And so we get the upside exposure. There's leverage to the ounces in the ground. We have 85 million gold equivalent ounces under royalty in the ground, under resource. We have the upside attached to increases in production, new discoveries, and increase in metal prices at the end of the day. And all of that overlaying what is, many ounces in the ground over great projects with engineering studies advancing that we're not paying more money for, and we're not exposed to those rising cost pressures. So a royalty company is generally a very good asset class for a generalist investor to look at that likes metals, wants leverage to metal prices, but wants to take a little bit of that risk off the table, especially the kinds of risks that mining companies unfortunately face today.
Hey, so you mentioned investing for inflationary times, and you think that royalties really fit the bill for that?
I do. You want, I think the investors in the audience that you serve, you're looking for a way to create value at lower risk. Royalty companies do that. We give you that upside, but we do it in a way that's diminished risk. And the way our company, Vox, was built was with a technical team at the front line. So it's a team of mining engineers and geologists picking the best assets all around the world that have royalties over them that we can buy at good value. And so we start with a funnel of 1,000 projects pretty much every year that we're screening through and risking and evaluating. And we end up doing anywhere between 5 and 10 deals a year on average. But those 5 to 10 deals, those are royalties that we buy, are the absolute best of the best. So a couple of weeks ago, we announced a deal on an asset that had 50 million gold equivalent ounces under royalty, under resource, that we were able to buy for $1.5 million in stock up front, and that stock's restricted for 2 years. That was one of the highest quality opportunities we had seen in our entire lifetime in this industry. But that's what we're looking for. And we continue to have a pipeline of those opportunities and what we call organic growth. So it's the value in the portfolio that we're not paying anything more for today. We bought those royalties, they're in the portfolio, and they're experiencing immense growth that we're not paying for. And so the investor gets the advantage of being in that position by owning shares in a royalty company like Vox.
All right. Well, I like the concept. I like the inflation hedge protection on the upside that should fuel major profits down the road for sure, because this inflationary mess that you find yourself in right now is just not going away tomorrow. I mean, I hear people saying, well, the market's saying that inflation's going to come under control. I'd like to know how this is going to happen. I got a couple of years on you, Kyle, and I remember the 70s, inflationary, guns and butter, all that stuff vividly. That's when I first really gotten interested in the economy, and I see a lot of similarities between this period in time and that period in time, except that potentially this period could well be worse. Well, I don't want to be a pessimist because you can profit by inflation. If you listen to this show, you know that inflation can be an investor's best friend if you get it and if you act. Kyle, really appreciate it. People want to find out more about Vox, about you. Where is the best place to go?
Absolutely. So voxroyalty.com. We're also on all of the typical social media channels and outlets as well. And then also, if you'd like to send an email, it's ir@voxroyalty.com. Most of the time I'm answering those emails personally. So Kerry, thanks for having us on the program. It was a true privilege and pleasure.
Hey, thank you. And hey, next time we have you on, maybe we'll talk about the tax benefits that royalty streaming companies enjoy, because they are enormous, potentially in the future. It's one of my favorite things about this sector that most of you out there don't even know about, the tax advantaged nature of the companies. Kyle, really appreciate it. If you got a question for Kyle, shoot me an email, kl@kerrylutz.com. Thanks, Kyle.
Thanks, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.